Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, I've met a lot of people that are near retirement age or who have just retired that are worried about their cash flows because they're not regularly earning an income. And of course, some of them have pension money coming in, but it's not a lot and it's not enough to take care of their requirements on an ongoing basis. So their primary question is, should I get a fixed deposit done where the interest payment gives me how much I need for the rest of the year? Should I leave the amount that I need for 3 months or 4 months at a time in a savings bank account and withdraw as and when from my investments? Or should I do a systematic withdrawal plan? What is the best approach here? And what is a systematic withdrawal plan if you've never heard about it? Let's talk about what the ideal way to operate this is. I'm joined today by Juzer Gabajiwala, who's Director of Ventura Securities. Juzer, thanks so much for taking the time. And I want to start with that question because there are a few options. There are a lot of people in that age group that have extra real estate. Extra, by extra I mean something that they might have bought in the early 2000s, a second flat maybe, that they've put on rent, and that gives them a certain amount of cash flow. What is the best approach? Should you have an SWP or systematic withdrawal plan? Should you have rent, or should you have a fixed deposit?
Yeah, so thanks, Alex, for having me on your show. It's a very interesting topic, and in fact, a lot of people do come to us with a solution to their problem, that how they should manage the cash flow. So these are the three basic sources. Basically, how investors look at is that you have a property and you are looking at a rental income which is coming in, right? Unfortunate of rental income is that the yields are very low, and so you may have invested maybe 10 lakhs, but what most of the investors tend to miss out is that if today the property is worth 1 crore, and if in the entire year you are going to get only 3 lakhs rupees as rent, then your yield is only 3%. So property from a point of view of investment is a very dicey investment to depend on as a cash flow, because it will require a larger outlay of money and your cash flow will be limited, and plus you have the headache of finding a rental, a proper tenant who will pay you on time. Again, it is an illiquid asset. It is not something which you can sell off immediately when you need it. So investment in a property is one of the last options one should look at if the person is looking at a income from that asset. Okay, if you have too much amount of money and if you are allocating towards property, that's a different matter. That is one thing with regard to property. When you come to fixed deposit, ideally you should do fixed deposit to the extent where you are at least even tax efficient. So if you are in the lower tax bracket or nil tax bracket, to that extent you can do a fixed deposit because you require a regular cash flow.
Yeah.
So ideally your fixed income should be for your non-negotiable expenses, okay? Because that is something which you need, right? So you need to pay your electricity bills, you need to have your meals, you need to pay your dues of your flat every month. So ideally you should look at that as a fixed income component. So that is something which can be like a fixed deposit. So you know that your expenses are absolutely fixed. So you are also getting an income which is fixed. And if you may have a lot of variable expenses. What I mean by variable expenses is that you can even look at it from an inflation management point of view, that the cost keeps on going up. We have variable expenses in terms of I want to go for a holiday, I want to even go and spend out money today. Sometimes certain unforeseen expenses also happen.
Yeah.
So that is something that an extremely good product which is available in mutual fund, which is called the systematic withdrawal plan. Right? So that is exactly the opposite of a systematic investment plan. In systematic investment plan, which I think SIPs as it is more popularly known as,
Yeah.
and most of the investors are today aware about it. So you are doing a regular investment every month. You are doing an investment, and it is going into your investment kitty.
Sure. So I want to ask you this, and just to sum up what you've spoken about, we'll delve a little deeper into the SWP right now. But what you're saying is rent should be your last option because of the nature of the product right now. Of course, down the road, you might have better yields, as you've talked about, and yield effectively is what you're receiving on an annual basis as a percentage of the overall value of the property. So the opportunity cost is effectively, if you were to sell that property and you were to put it in a fixed deposit, you would effectively get more than double of what you're getting as rent. Simple, right? So therefore, rent is the last option available to you. The second option, and what you should consider for your regular requirements, and you can actually just measure that. If you're spending a certain amount every month, then you can do a fixed deposit and you can have whatever you need for the short term taken care of with that fixed deposit, as long as your income is up to 12 lakh, in which case you're paying no tax, and so it's quite efficient in that manner. But you're spending money and things that are maybe not foreseen, you can actually use an SWP. So let's talk about an example, right? Because you've shared an example with me. How does that work out? Maybe we can talk about that.
Yeah, so and this is basically what we tell investors is that ideally you should plan your systematic withdrawal in such a manner that you are also tax efficient. You also take care of inflation, and one of the things which is not factored in by many individuals nowadays is the lifestyle cost. Okay, so in fact the lifestyle cost is the one which is going to increase, and what I mean by lifestyle cost is that basically now you have a lot of eating out, people upgrade their mobiles, it is inflation is very basic, right? And inflation will keep on going down as we grow as an economy. So inflation will stabilize. The government.
But what is this example, Juicer?
Yeah. So basically, what we say is that you should invest around, let us say we took an investment of around 10 lakhs. You invest on day one and you let that money accumulate some wealth for a 3-year time horizon. The reason 3 years is that 3 years is a reasonably good time where your value can grow, because as we know that the equity returns are not in a straight line upward, they will be volatile. So we assume a 10% return, trying to be conservative. So you hold that investment for 3 years, and from 4th year onwards, if you start a cash withdrawal at around 6% of the corpus, right, and you can even step it up every year by 7% to take care of your the inflationary needs plus your lifestyle needs, right? So it can become a very tax efficient way of doing the withdrawal, because ideally, let us say if you are doing a 6% withdrawal, so in the 4th year you will withdraw around 60,000, right? So your effective tax rate will be just around 4%. And as you keep on growing, you can keep this amount perpetually going on, and you can increase your SWP every year by 7%. So by the 25th year, you will be approximately at around 2,48,000, and your effective tax rate will still be at around 11.4. And the beauty of this is that even after this, at the end, and I'm assuming a return of only 10% till perpetuity, so you will always have a additional surplus available to you. And the first 3 years are used to accumulate so that you don't feel that you are going to be withdrawing from your principal amount, because that is.
I have a clarification to ask, Juicer. This sounds incredible on paper, and I just want to understand what product we're talking about. Because if we're talking about equity, there is no guarantee that we will gain at 10% per year. I know that your assumption is not equity. That's why I'm asking you. You're effectively talking about a hybrid product. So people should not get the wrong idea. You don't invest in an equity or pure equity product expecting that you will get 10% per year and then withdraw a consistent amount every year and think that that principle will remain untouched, because it's quite possible that it will erode completely. So therefore, what product is ideal for something like this?
So in fact, we have assumed a multi-asset allocation product over here, and which is again more conservative in the equity allocation. And we have also assumed that the product will have a 2-year horizon for a long-term capital gains tax. So less than 2 years will be short term at the slab rate. So we are basically assuming our equity allocation between 35 to 50%
Okay.
over here.
Okay.
And that is why I'm giving a 3 year time horizon for the amount to accumulate, because I understand that it will not grow at 10% every year.
Fantastic. So, therefore, clarification, when you say perpetuity based on the measure that we're talking about, and here, frankly, I know that you've taken an example of 10 lakh, which is good for a lot of people to understand, but really the cohort that we're talking about, the people that we're talking about have saved a certain amount of money over the course of their lifetime. So they have access to more than 10 lakh rupees. So you can actually easily multiply that and talk about 50 lakh rupees or a crore or even more than that, and effectively work out how much you can withdraw and have access to. You don't necessarily have to have what is the value, 6% per year withdrawal. You can actually have a smaller amount, in which case your corpus will continue to grow even more, right? So the question that I have for you is, does this capital stay till the end and keep growing?
Yeah, so here the biggest factor which is there in the assumption is with regard to the return, right?
Yeah.
I mean, and the return is higher than the withdrawal. So we are trying to be, the reason of 6% is that any investor normally expects that he will get that kind of return from a bank fixed deposit, right? So that is the reason why we have kept it at around 6%. We have taken inflation at a slightly higher rate, right? You could, even if you narrow down your return to around 9%, you will still have a positive amount left. That is the reason that I have also said that for the first 3 years you should not do a withdrawal. So most of the investors who come to us, they want to do a SWP from day one.
Sure.
Right? By doing from day one, right, you may not have a 10% return in the first year, right? It could be less than even 6%, and suddenly you will end up seeing that the 10 lakhs has become negative, and that is when the panic starts.
Sure, makes sense. Let me ask you this though, in your experience, and I've certainly found this to be the case, and I guess anecdotal evidence will tell you that as well, but you've spoken to many more people, I'm sure, than I have. Do you think that people of that age group, we're talking about 55 to 65 to 70 or thereabouts, tend to have most of their money in fixed income and particularly fixed deposit, and effectively, therefore, they are pretty inefficient with the way that they're saving?
Yeah, so what happens is that you generally tend to see that there is always a fear that you will run out of money. Okay, I mean, I think that is a fear which a person has the moment when he reaches his, I will actually call it financial independence and not retirement now, because most of the individuals even after 60 tend to work and do something. So it depends upon individual to individual, and the only thing what happens is that he stops becoming a performing asset, and he has to depend on his investments to carry out his lifestyle. And everybody.
Yeah, in a lot of cases that investment is their children or is the children, because and that's how they think, because they say, oh, my children are going to take care of me, they're my biggest investment. But having said that, I do want to ask you, and this is the last question that I will ask you, is that a lot of people say that you need to have equity because this is the only thing that will consistently help you beat inflation over the long term. But how much is appropriate? And I know this is a difficult question to answer. Everybody has to come up with their own answer. But in your opinion, as an advisor, what is the bare minimum that is appropriate?
So see, one thing what has happened is that people forget that if you let us say you retire generally at around 60, right? The life expectancy in India has also gone up, right? We are talking about 80, so we are talking about good 20 years, right? So and equity is the only product which will will help you to beat inflation plus also meet your lifestyle cost, right? So not having equity would not give him a proper tax efficient return. Right. So I look at it that at least around 20 to 30%, depending upon his risk profile, you should be having investment in equity where specifically when you have a 5 to 10 year plus time horizon. So you should have around 20% on a bare minimum as a equity investment.
And just a quick follow-up, this can be for example, part of what you spoke about, which is the multi-asset fund, which would effectively have something like this, right?
Correct, absolutely. So that is the whole objective, and by doing it under a hybrid product, and instead of doing a separate debt separately and equity separately, the hybrid actually gives you a very good tax efficiency in your returns. You don't pay any money on rebalancing. You don't have to do anything.
Great.
So it's a great product for people who are specifically in the retirement age. Multi-asset is there, hybrid is there, and now there's a lot of product innovation happening on the mutual fund side. So it can suit to each and every individual's needs.
Great. Yeah, and we've done conversations on multi-asset. I think it bears repeating again, and we will do that in just a bit. But Juzer, thanks so much for joining us this evening, and pleasure having you.
Thank you, Alex.